Hello and welcome to our first recording for 2022 of Analyst Insights. We hope you had a good Christmas and New Year's holiday. And just to let you know something that you probably already know, the markets were open even for most of the festive season, except for Christmas holidays and Boxing Day. So there's so much to talk about on the markets and also the economy as the year is starting. So I'm joined today by my colleague Rufaro. Welcome, Rufaro.
Hello, and compliments of the season to you, sir, and all our viewers.
Thanks. And yes, welcome to the show again. So let's just dive straight into it. One of the most topical issues last year was the issue to do with inflation. So with annual inflation ending the year at 60%, so it just tells you that if you were investing $100 by the end of the year, you were losing 60% of the value in terms of the in real terms. Looking at 2022, what are you seeing in terms of inflation developments going forward?
So if you look at 2021, what we saw at the beginning was very positive in terms of the inflation trend. Inflation started in triple digits and in double digits on a month-on-month basis, and it trended lower for most of the first half of the year. But then we saw a reversal towards the end of Q3, going into Q4, where month-on-month inflation started to tick up, and annual inflation also started to tick up, and we closed the year at 60%. So that's actually very high in terms of, I think the accountants would make the case that you have to do hyperinflationary accounts when you have inflation at those levels. So certainly what it tells us is that from an investment perspective, the Zim dollar is not a store of value, and any monetary assets that, like treasury bills or commercial paper that is paying coupons at less than the annual inflation rate. So if you're earning less than 60% per annum on any Zim dollar denominated paper, you're losing money in real terms. So, what that tells us is that and there are no assets really that are CPI indexed or where the interest rates or coupons are pegged at a rate higher than inflation. So what that tells us is that going into 2022, monetary assets are to be avoided like the plague, and investors, to the extent that they have capacity, should stick to non-monetary assets, whether it's shares listed on the ZSE or property or private equity or small businesses or US dollar cash. It doesn't make sense to hold Zim dollars.
But one would say when you look at the trajectory from when the year 2021 started, the rate was probably more than 500%, 800% thereabout. We ended the year at 60%. Obviously, that's some positive sort of trajectory when you look at it. Should we not expect that kind of trajectory going into 2022, where we are starting off with 60% and probably ending at lower double-digit numbers? Are you that optimistic?
So look, the trend was very encouraging at the beginning of last year. I think that there was a lot of fiscal discipline, and Treasury deserves credit for that. Money supply growth was slow. They reported surpluses, and they generally, our government generally lived within its means. So the trend, certainly throughout the first half of last year, was positive. However, we did see a reversal in this trend. We did see some money supply growth accelerate. We saw inflation accelerate. So that trend has certainly reversed. If you look at the month-on-month numbers, if you look at the annual inflation figures, it's the trend has certainly reversed. And if you look at the parallel market rate as an indicator of what's happening with inflation and with money supply, the movement was very modest in the first half of the year. And if you look at what's happened over the last 3 months, it's in fact it's moved quite aggressively to where it is today at 215, 220. So unless there is a significant change in Treasury's behavior in terms of the extent to which they're spending and increasing money supply growth, I think that trend right now, sadly, is in the wrong direction of inflation actually running away from us.
Okay.
So far, we haven't seen any evidence that this trend is reversing. Touch wood, it will reverse, and I'll be proved wrong. But if we extrapolate what was happening in Q4 last year through to the rest of 2022, then it's not an encouraging picture. It's a picture of high inflation, of significant Zim dollar devaluation.
Oh, okay. So let's talk about the markets. So earlier on, you had alluded to the fact that as inflation was raging, or we had high inflation numbers, there was a limited universe of assets that would come and give you a return above inflation. And the stock market was one of them. In fact, the ZSE was one of the best performers in the world in real terms. So, but one would pose the question, is the Zimbabwean economy the best performing in the economy? Or why? What was driving the ZSE at a time when maybe the economy was not at a world-beating kind of levels? And what's your outlook?
I think that's an excellent question. So, we certainly had the best performing market in the region. We had, I think, the performance in Zim dollar terms was north of 300%, and in real terms, punters on the ZSE would have done more than 100%. They would have doubled their money from the beginning of the year to the end of the year. So the question really is: are the underlying assets, the companies that are listed on the ZSE, are they pumping? Are they making money hand over fist? Do the earnings support the valuations, and does the outlook support the valuations?
And someone would say yes, because we're seeing volumes northwards of, in some cases, 50% growth, and probably that would justify the movements that we've seen on the stock market. But is that a correct assessment in your view?
So certainly a lot of the big blue chips saw significant volumes growth, in real terms. So if you actually look at a company like Delta and you look at the hectoliters that they moved, you saw an improvement from 2020. But I think it's important to be cognizant of the fact that the comparison between 2020 and 2021 is 2020 we were coming off a low base. There was a drought in 2020, and we had the worst of the COVID in terms of lockdowns and restricted economic activity. So 2020 was a bad year, and when you compare 2021 to 2022, you have to remember that one is working off a particularly and unusually low base. Yeah, so that's the first thing. And if you actually look at the positive performance of the companies in terms of their earnings or the volumes that they're moving, and the movement in the valuations, you'll find that the valuations have moved way ahead of the performance of the underlying companies. So, why is that the case? Is the outlook incredibly exciting? Can we extrapolate the growth that we saw last year into this year and going forward, or there's something else at play? And I would make the case that there's something else at play here. What it is that the capital markets community understands that holding Zim dollars is a losing proposition. So to the extent that they have Zim dollars excess to their requirements, the Zimbabwe Stock Exchange is a home for that money. And the capital markets community is not particularly concerned with valuations, because they're in a place where they have bad options in front of them, and they're asking themselves the question, which is the least bad option? Because certainly keeping Zim dollars in a bank account is the worst option. So if they've got enough to buy property, maybe it makes sense to buy property. If they can find exciting private equity opportunities, they would invest in that space. To the extent that they can't find other opportunities, the ZSE is the easiest. The ticket sizes are very flexible, so you can just buy a blue chip. Even if you think it's overvalued, you're going to get a better outcome than holding on to Zim dollars. So that's the behavior that I believe has underpins the performance we've seen on the ZSE, and what it also tells us, I think the aggressive movement on the ZSE is an indicator of what's going to happen on the parallel market. So what we've seen throughout most of last year is that movement on the ZSE is a lead indicator of movement on the parallel market. So the ZSE moves up in real terms, and then there's a movement in the parallel market, and the real value of the market then comes off. So what I would focus, say, for Q1 2022 is, given the run-up that we saw in the ZSE, we should expect the parallel market to move up, to catch up to the movement we've seen on the ZSE.
Yeah, but one would say maybe that's a rather pessimistic view if you compare the fact that the real sector was actually showing some improvement. For example, you are seeing we had the bumper harvest. Obviously, we can debate about the size of the bumper harvest, but certainly we didn't have grain shortages in 2021 season. And also, in terms of what you are seeing on inflation developments, where the numbers are coming off high three-digit figures to around 60s. And then you are looking at maybe infrastructure developments that are taking place, especially when you're looking at the roads. And then you add our foreign currency receipts. They've actually increased. We were actually expecting to end the year around 8 billion when you look at the remittances, the export receipts, and weather grants and all. Can't you say the real sector was performing to a position where maybe it's justifying part of what you are seeing on the stock market? How would you respond to that? And at what point should we expect the market to start responding to rather positive news that are probably happening on the real sector, versus maybe the worry that the rate is going to run away from the auction rate? How would you respond to?
So I think you make valid points there. The economy, the real sector, whichever way you want to look at it or describe it, has done better last year than it did in 2020. So we, like you indicated, we had we didn't have a drought, and we had significantly better production in agriculture. If you look at the platinum mines, they've done significantly better, as well as the commodity prices globally have boomed, and they've continued to increase production. So, and we've seen infrastructure development. So the economy has definitely done significantly better last year compared to 2020. The question from a ZSE perspective is, does that justify the adjustment we've seen in the valuations? Because we've seen, in real terms, in aggregate, the market more than double in value. Has our economy, compared to where we were in 2020, doubled? And is the outlook for growth going forward, does it justify the valuations that we're seeing on the ZSE? My sense is that the answer to that is no. If anything, the market, I think it should have re-rated higher from the low base in 2020, but I think it's overshot. And I think what we're seeing with inflation, double-digit inflation at 60% annually, and the uptick in month-to-month inflation, if you look at, it's been ticking upwards, from October, November, December. If that trend continues, then we will see the parallel market continue to move the way we've seen it move over the last 30 days. And the real valuation of the ZSE will then shrink to more reasonable levels.
Yeah, talking about the parallel market, we in the last month of 2021, and maybe also getting into the new year, we actually saw the gap between the parallel market and the auction rate actually widening, and especially as you get into the first week of January. And also prior to that, we saw the central bank actually saying that we're going to have a break in the auction, maybe a 3 week break because of the holidays. And maybe one would ask the question, and maybe what would you say to that break, vis-a-vis the fact that maybe the entire banking sector was still working? And is it really, how does that relate with the fact that the economy doesn't really stop? If the auction was being helpful as it was in terms of being providing the US dollar liquidity. What do you think was the reason behind us taking a three-week break in terms of the auction being used as a means to get foreign currency for the economy?
So before the break, the auction already had quite a few challenges in terms of backlog, in terms of the market not being satisfied with its transparency and the fact that it's a place where willing buyers and willing sellers meet. And it is curious that, because there's a lot of things that are happening in our banking sector, it is curious that the auction is the only part of the banking sector that all of them need to take a break for 3 weeks at the same time, and everything else in banking carries on. So it doesn't bode well for an analysis of to what extent the currency is actually available for allocation. Because if the currency is available and we want our economy to grow and thrive, then why pause allocations for 3 weeks? So it does raise questions about the availability of currency. And if you look at what's happening on the power market, especially since the auction has taken a hiatus, what the market is telling us is that they have little faith in being satisfied come next week when the auction
opens again. Anyway, let's talk about COVID. Topical issue again last year in 2020, in 2020 also. So we had Omicron in the last quarter of 2021, and different countries reacted differently, including us here. First of all, do you think we reacted well when this Omicron was announced, especially the decision to require that all inbound traffic be quarantined for 10 days, and obviously going into 2022, what do you think we should do differently if this pandemic persists, and whenever there are some new outbreaks of new variants of COVID?
So I think, look, with COVID, since it appeared in earnest in March 2020, I think governments across the world, for the most part, have been at best clumsy, in some cases outright incompetent in terms of the way they've managed it. And since then, I think that a lot of the policy action we've seen in terms of dealing with COVID has been more about being seen to be doing something than actually what the experts, recommend would be best. The way, 2 years later, the way I think about it is that it's not going away. I don't think Omicron is the last variant. There are going to be variants and waves in our future. Maybe we'll be lucky and there will be an effective therapy that deals with it. But until then, I think that COVID is with us and we have to learn to live with it. Now, the question is, are the politicians going to are they going to deal with it differently going forward? Or are we going to see similar panics, whenever there's a new variant, like red lists and additional lockdowns and that sort of thing? That's unknown. Hopefully they will do the right thing, but I think realistically, we would, I foresee disruptions here and there as there are new waves and variants.
Okay, maybe just to conclude, maybe a look again at market developments. So this week we saw Morgan & Company launching an ETF, and also we know that end of December was maybe 31 December actually was the last day in office for now former CEO of SEC, Tafazwa Chinamo. And recently we also saw some news that the Securities and Exchange Commission is now an associate member of the International Organization of Securities Commissions. What would be your views on these market developments and also even in terms of what it says about the outlook of our capital markets?
I think these are all very positive developments. I think the membership in this international organization of securities regulators is a feather in Tafazo's cap. I think he will have a great legacy because before he came through, we had manual trading. We moved to automated trading. We've had all these positive developments during his tenure. So I think he's done incredibly well as the capital markets regulator over the last 10 years, and he will be sorely missed. I think it's a positive development that we have new products on the ZSE, like this Morgan and Co. ETF. I think what we've seen over the last few years on the ZSE really is that it's been shrinking. The number of listings have come off, and we haven't seen a lot of new listings. So I think it's a positive development to see participants create new products. Hopefully, in 2022, we will see additional listings of exciting new products.
Thanks so much, Rufaro, for the usual good insights from you. And to our viewers, thanks so much for joining in. And we want to hear your comments. If you've got questions, anything related to our capital markets, please feel free to bring them to our attention. We want to be able to respond to your questions and to make sure that you are benefiting more from the insights that we are bringing to you. Thank you very much. I'll see you next time. Bye-bye.